Hey, welcome back to our channel where we break complex money matters into simple, actionable steps. If you've ever wondered how to build a successful investment portfolio, or if you're trying to make sense of stock, bonds, ETF, and the rest of that, you are in the right place, because in this video today, we are going to break down exactly what it takes to build an investment that works for you. By the end of this video, you'll walk away with a crystal clear strategy on how to grow your wealth, reduce your risk, and make right decision with your money. I will tell you, grab your notepad or your note app. Let's dive in. But before we go into that detail, you are meeting me for the first time on YouTube and you are like, who's this guy? My name is Larry. I am an economist who have immersed himself in the field of finance and money through personal research, and I spent over a decade researching about finance and money. And in this channel, we talk about personal finance, we talk about business, marketing, and sales. If these are the kind of content you love to see, please do it to hit that subscribe button, hit the notification bell so you don't have to miss any of our videos. And to our returning subscribers, kudos to you guys, kudos to you guys. And if you like this our video in any way, please do it to give us a thumbs up. It means a lot to us. Now, the detail. First, let's clear up the basics. What is an investment portfolio? An investment portfolio is simply a collection of assets, as in things like stock, bonds, mutual fund, ETF, real estate, even crypto. Simply anything you put your money to see it grow over time. Just think of it like a recipe. You are mixing different ingredients together to give you something balanced, something powerful, something that suits your taste. That's the heart of a good portfolio: balance and personalization. Now we know the basics. What is the first step towards building a successful investment portfolio? Now, the reality is this. Before you spend a single dollar, ask yourself, what am I investing for? Which means the very first step to building a successful investment portfolio is setting your goal. What are you investing for? What are you saving for? Are you saving for retirement 30 years from now? Or you are saving to buy a house in 5 years' time? Or you are saving to fund child's education, or you want to build generational wealth? Now, you have to set your goal. Your goal is what defines your strategy. Like a long-term plan may lean heavily on stock. But if you have a short-term goal, you might depend on more stable investment like bonds. But if you don't have any goal, then you don't have a game plan, because the first step to building an investment portfolio that works for you is setting your goal, which defines your strategy. Step number 2, understand your risk tolerance. This part is personal. How much risk can you chest? How much risk can you stomach? Now, there is no shame in being risk averse. If you are the kind of person that panic every time the stock market drops, then a conservative portfolio might make you sleep better. But if you've got a long-time horizon, you are okay with short dips, short fluctuation for a long-term gain, then you can take more risk and think of that like your investment personality. Now, let's talk strategy. When you talk about strategy, you think of diversification. Diversification is the golden rule of a successful investing. But why? Why is diversification the golden rule of investing? It is because when one investment goes down, the other can hold you up. Let's assume you only invest in tech stock. Now, if that setup crashes, your whole portfolio will take a hit. But if you have other investment like bonds, you have other investment like real estate and any other investment, the damage will be minimized. This will help to remind the saying, don't put all your eggs in one basket. Now, there are some diversification strategy that could apply. You could use 60-40 split between stock and bonds. You have to know it's not about avoiding risk. It's about spreading wisely. Step number 5 towards building a successful investment portfolio that works for you talks about asset allocation. That is choosing your mix. Asset allocation is the blueprint of your investment portfolio. For example, a 25 years old may go 90% stock, 10% bond. But a 55 years old close to retirement might flip that. Now, to give us a rough guide based on risk tolerance and age, if you are an aggressive investor, you are an aggressive risk taker, you could go for 90% stock, 10% bond. That is higher returns, higher volatility, that's higher risk. But if you are a moderate investor, you can go 70 stock, 30 bonds. But if you are a conservative, going 50-50 is better. Lower risk, lower returns. Remember, you are not copying someone else's portfolio, rather you are building your own. Because some people are aggressive, some people are moderate, some people are conservative. If conservative follow an aggressive to invest, it may be suicidal when market take hard fluctuations. Step number 6 talks about low-cost investing. To build a successful investment portfolio, you must understand low-cost investing, understanding those investments that have minimal fee and maximum return. Fee are the silent killer of wealth creation. Now, imagine if you are paying 1% management fee for a period of 30 years, you are going to spend hundreds of thousands of dollars that could have been a potential profit. This is why some smart investors prefer low-cost index funds and ETF. Now, if you want to see investment that have high cost charge, high fee, you can use apps like Fidelity or Vanguard to see some investment with low fee. Step number 7, you have to monitor, review, and balance. Your investment is not a cocktail. You can't just set it and leave it. Your life changes, the market changes. Review your investment at least once a year. Rebalancing means adjusting your asset allocation back to the original target. If stock outperform now 80% instead of 70%, sell a little and buy bond. This helps to keep your risk level at the exact point that you want it. Next is automation and dollar cost averaging. You want investing easier? Automate it. Set up automatic transfer into your investment account every month, and that is called dollar cost averaging. It helps to reduce risk of buying at the wrong time. It also builds discipline, and in investing, discipline beats emotion anytime, any day. To cap this video and giving some quick hit on what not to do, don't chase trend or meme stock. Don't time the market, you won't win. Don't panic sell during downturn, and don't invest without a plan. The market rewards consistency and not chaos. In conclusion, building a successful investment portfolio does not require a final degree. It requires intention, patience, and your willingness to learn. Start with a clear goal. Know your comfort with risk. Diversify. Keep costs low. Stay consistent and make sure that you give it time. Wealth doesn't come overnight, but it comes with strategy and plan. If you find this video helpful in any way, don't forget to hit the subscribe button. Give the video a thumbs up because it means a lot to us, and thank you for coming to our channel today. If you also want us to talk detail about stock, drop it in the comment section. Thank you for watching, and bye for now.